Welcome back, folks. This is Blake Bunch, PWA, here to discuss what issues you should consider when harvesting capital losses. Selling some investments that have unrealized tax loss has the potential to offset the tax liability that is triggered when other investments are sold at a gain. This strategy is called tax loss harvesting, and it's one we consider for our clients. Now, it's a great time for us as a team to take this strategy under advisement. What may seem like a straightforward strategy, however, can be filled with subtle complexities that we should explore. There are a lot of issues to consider. A few include whether you anticipate a tax rate change, have realized gains or losses, or even losses that you're carrying over from previous years, which may affect your tax loss harvesting strategy. Plan to reinvest your tax savings for future growth? The decision to pursue a tax loss harvesting strategy can be highly individualized. In addition to general issues, there are tax considerations, long-term issues, and implementation concerns that should factor into your well-thought-out decision. You can count on us to walk you through the important points so you are confident you've taken the actions that you will support your long-term financial plan. To facilitate a productive discussion, we have a checklist that outlines 16 considerations that are fundamental to evaluating whether or not harvest capital losses are in your best interest. While the checklist can help you spot good ways to identify all the different opportunities to consider, in your next PWA call, we can identify what the best opportunities are for you. Thanks for tuning in, and if you found this useful, don't forget to like and subscribe.